Welcome, my dear friends and investors. It's another month and another update. So what are we going to talk about this month? Well, the earnings season is now over and out. When I spoke to you the last month, just about half of the 500 companies had declared their results. Now we have the full picture. So let's see what the full picture tells us, right? So we go back and look at the overall top 500 companies. And in the third quarter, we've seen that the top line has grown by about 4.5%, and the bottom line YOY growth has been 23%. So quite robust. And if we look at the non-financial 417 odd companies, then the bottom line growth is a very healthy 30%. So what are the takeaways? Two observations in my view. One is that the quarterly run rate of PAT growth is still very healthy. 30% for non-financials can be considered to be very healthy. Again, in this year, we saw a 190 basis point expansion in margins. But now, I think pretty much with the end of the third quarter, we've seen that all the benefit of margin expansion, at least comparing it to the base of last year, is now recouped, right? So from here on, if we want to get a healthy double-digit returns or PAT growth, we will need both. We will need top-line growth as well as margin growth. And I believe that the reason why the top-line growth still continues to be very anemic is because the inflation impact in the base quarter still continues to be reasonably high. If we now look at not just the quarter but the full picture of the first 9 months, then we see that essentially for the top 500 companies, for the first 9 months, the PAT has grown at 34%. And if you take non-financials, it has grown at a staggering 40%. So the first 9 months, your top 500 companies have delivered 30% plus earnings growth. If you look at the Nifty, for the first 9 months, it's 26 and 23%. So what that tells you is that the broader markets or a larger width of companies, the 450 companies out of the top 500 continues to grow faster than the 50 companies. But a 25% growth in Nifty itself is nothing to laugh about. Now if we look at, we compare at the 9-month earnings growth with the 9-month returns, it's quite not very surprising that the returns and the earnings growth both for the Nifty 50 as well as the 500 companies is almost similar. So for the first 9 months, Nifty 50 earnings growth has been 26% and the Nifty returns have been 25%. That is from April to December. Similarly, for the top 500 companies, the returns have been 33% and the earnings growth has been 34%. So returns have been exactly in line with earnings growth for the first 9 months of this financial year. And now coming to what are the hits and misses of some of our top positions now that the earnings season is fully through and we have the full picture. By and large, I'm happy to say that a majority of our companies have met or beaten expectations. And I'll quickly run you through the list. Amongst the hits, TVS Motors, we saw margin expansion. Hitachi Energy, we saw a very healthy order book. L&T, it beat on order inflow as well as a very strong guidance. Persistent Systems, industry leading revenue growth. KPIT surpassed its guidance comfortably. SBFC had strong margins and improving ROA. Dixon strong mobile growth and improving ROA. Trent, absolutely blowout numbers, very strong growth, defying the general consumption slowdown that we've seen in a lot of other consumer companies. ABB, again stellar, very strong growth and a very strong order book, a record order book, and it was a record quarter. Reliance, cash flows have started to improve. Varun Beverages, we saw both superb volume growth with margin expansion. United Spirits, surprised on margins. We continue to see margin expansion because of premiumization. Sun Pharma, it's been a recent entrant in our portfolio, has seen very strong growth in the specialty pharma segment. MCX, again very strong volume growth, especially in the option segment. And Tata Motors, where we saw very strong performance from JLR and the commercial vehicle business and strong cash flows. What were the misses? Well, the misses were not very depressing. In fact, the misses were in some areas of the business. So LXE, media and broadcast continues to be flattish and sluggish. In Bajaj Finance, while customer acquisition was strong, margins were strong, credit costs were slightly higher. In Dynamatics, well, aerospace did very well, but metallurgy in Europe has struggled. And this is something that we've seen across companies which have operations in Europe or exports to Europe. Europe has been a little bit of a problem area, but otherwise solid numbers. Info Edge, we continue to see slowdown in IT hiring. So other than that, non-IT hiring did very well, but IT hiring is still about 50%, so we've seen a slowdown. However, they've said that they're seeing a bottoming out there. And lastly, Divi's Lab, while we did see some improvement in margins, it is still way below the potential margins that Divi's has generated in the past. So on the whole, if I were to summarize, I think it's been a very fruitful third quarter result season, both for the markets as well as for our underlying portfolio companies. We've seen more hits than misses, and that we believe is reflective of the performance of our portfolios, which continue to outperform. We hope that this trend continues. So until next month, goodbye.